Gold Fields has undergone a structural transformation over the last 5 years, evolving into a global gold producer with a diversified portfolio. The reorientation of the group has focused on improving the jurisdictional quality of its production base, with a heavy emphasis on Tier 1 mining, such as in Australia and Canada, while optimizing its foundational positions in Ghana, Peru, and South Africa. As of late 2025, the company is operating 9 mines and has a significant growth pipeline. Historically, the company was heavily weighted toward deep-level mining in South Africa, which presented significant technical and operational risks. Today, the portfolio is anchored by 4 multi-decade foundation assets that provide a stable production baseload, while an additional 4 assets offer considerable upside optionality through exploration and brownfields development.
By the end of the 2024 financial year, the Australian region had become the largest contributor to the group's production profile, accounting for 46% of total gold output, followed by Ghana at 31%, South Africa at 13%, Peru at 8%, and Chile at 2%, as the Salares Norte project commenced its initial ramp-up. The company's commitment to improving portfolio quality is evidenced by its active management of assets. In 2024, Gold Fields finalized several key divestments, including its 45% interest in the Asanko gold mine in Ghana and its 24% equity stake in Cerro Mining.
These moves were complemented by the termination of the option agreement for the far southeast asset in the Philippines, reflecting an exit from non-core or lower-margin positions. Simultaneously, the group has pursued high-value acquisitions, most notably the consolidation of full ownership in the Windfall project in Canada and the Gruyere mine in Australia. This has resulted in a more resilient production profile that is less susceptible to regional disruptions. The Australian operations are the primary engine of free cash flow for Gold Fields, characterized by mechanized, high-efficiency mining across 4 main sites. The St. Ives mine is a cornerstone of this region, producing 372,000 ounces in 2023 and 331,000 ounces in 2024. Although production saw a temporary decline in 2024 due to lower grades and increased stripping requirements at the Swift Shore and Invincible Footwall South pits, the mine is expected to deliver a strong recovery in late 2025. A significant portion of capital expenditure at St. Ives has been directed toward the development of a renewable energy microgrid, with a total spend of $200 million Australian dollars in 2024, which is expected to lower long-term operating costs by reducing reliance on external power and diesel. The Agnew mine has demonstrated steady growth, with production increasing to 287,000 ounces in 2024, supported by high-grade ore from the Redeemer Underground Complex and the Wahroonga mine. Exploration success at Agnew has been particularly noteworthy, with focused near-mine drilling extending the mineral reserve base and providing a clear runway for future production. Meanwhile, the Granny Smith mine produced 284,000 ounces in 2023, with current development efforts focused on the Wallaby Underground mine, where depth extensions continue to yield high-quality resources. The Gruyere mine, a 50-50 joint venture that Gold Fields moved to consolidate fully in 2025, produced 322,000 ounces in 2023. The mine faced severe operational headwinds in the first half of 2024 following record rainfall that impacted pit access and processing schedules, leading to a 10% decrease in production for that period. However, a significant turnaround was achieved in the second half of 2024, and the acquisition of the remaining stake from Gold Road Resources for $1,450 million is expected to add significant attributable ounces to the group's 2025 profile. The Australian assets collectively maintained an all-in cost of $1,253 per ounce in 2023, although inflationary pressures on labor and contractor rates drove local currency costs higher by 14% year-on-year. In Ghana, Gold Fields operates the Tarkwa and Damang mines, which are pivotal to the group's West African strategy. Tarkwa is a high-volume open-pit operation that produced 551,000 ounces in 2023 and 484,000 attributable ounces in 2024. The decrease in 2024 output was largely a function of lower grades and the initiation of an accelerated waste stripping program designed to unlock higher-grade ore in 2025 and 2026. The mine remains a significant cash generator, with a free cash flow yield of 17% reported in 2024, despite the high levels of stripping capital. The Damang mine is currently in a transitional phase as it processes lower-grade stockpiles. Production at Damang fell by 34% to 153,000 ounces in 2023. The company reached an agreement with the government of Ghana in early 2025 to extend the Damang main mining lease for 12 months, allowing for a comprehensive assessment of the remaining resources below the current pit floor.
This extension provides the group with optionality to either reinvest in a significant pit expansion or proceed with a responsible closure and rehabilitation plan. The divestment of the Asanko mine in March 2024 for $170 million further simplified the Ghanaian portfolio, allowing management to concentrate technical resources on the Tarkwa Iduaprium joint venture opportunity. The South Deep mine in South Africa represents the group's only remaining domestic asset and is a unique, high-tonnage, mechanized underground operation. The mine produced 311,000 ounces in 2023 at an all-in cost of $1,349 per ounce. However, the first half of 2024 was marked by significant operational difficulties, including challenging ground conditions and backfill rehandling issues that hampered stope access and grade mix. These technical hurdles led to a 17% decline in production for 2024, totaling 258,000 ounces. By the end of 2024, the implementation of a turnaround plan resulted in a material step-up in performance, with production in the first half of 2025 reaching 148,000 ounces, a 31% increase over the previous year. South Deep remains a cornerstone long-life asset, with the aim of reaching a steady-state output of 11 tons of gold per year.
In the Americas, the Cerro Corona mine in Peru is a significant producer of both gold and copper. Equivalent gold production was 238,000 ounces in 2023, though output decreased in 2024 due to lower grades and unfavorable copper price adjustments affecting the gold equivalent calculation. Cerro Corona is approaching a critical juncture in its life of mine plan, with 2025 set to be the final year of mining before the operation shifts exclusively to processing stockpiles through 2031. Despite its maturing nature, the mine generated $75 million in adjusted free cash flow in 2023 and remains a low-cost contributor when copper credits are factored in. The Salares Norte project in Chile is the company's most important near-term growth catalyst. Following a series of delays due to severe winter weather and commissioning challenges, the mine poured its first gold in April 2024. The project produced 45,000 ounces in the fourth quarter of 2024 and is guided to produce between 325,000 and 375,000 gold equivalent ounces in 2025.
At full steady-state production, which is expected by 2026, Salares Norte is forecast to produce 580,000 ounces annually at an all-in sustaining cost of approximately $825 to $875 per ounce, making it one of the lowest-cost mines in the world. Growth pipeline, the Windfall Project acquisition. The acquisition of Osisko Mining and its flagship Windfall project in Quebec, Canada, marks a transformative entry into the Canadian market for goldfields. The company initially acquired a 50% interest in the project in May 2023 for 600 million Canadian dollars, followed by a full consolidation in October 2024 for an additional 1,930 million Canadian dollars. Windfall is a high-grade underground deposit with measured and indicated resources of 4,100,000 ounces at 11.4 grams per ton of gold.
The feasibility study for Windfall estimates an average annual production of 306,000 ounces over a 10-year life at an all-in sustaining cost of $729 per ounce. Gold Fields is currently focused on obtaining environmental permits and finalizing an impact benefit agreement with local Cree nations, with a final investment decision expected in the first quarter of 2026. First production is targeted for 2028, adding a low-cost, high-margin pillar to the group's production profile. The strategic rationale for the acquisition was further strengthened by the project's use of hydroelectric power, which significantly reduces the cost of energy and supports the long-term economic viability of the mine.
Mineral reserves. Gold Fields possesses one of the strongest reserve positions in the gold industry. supporting a portfolio-wide average life of mine exceeding 14 years. As of December 2024, attributable proved and probable mineral reserves stood at 44.3 million ounces of gold, 27.1 million pounds of copper, and 46 million ounces of silver. The group replaced 85% of its production depletion in 2024, with 2 million ounces of extraction being offset by 1,700,000 ounces of pre-depletion growth, primarily from brownfields exploration in Australia. The company's mineral resource base, exclusive of reserves, provides a significant pipeline for future growth, totaling 30.4 million ounces of measured and indicated gold resources. To reflect the prevailing metal price environment, Gold Fields revised its gold price assumptions in late 2025, increasing the reserve price to $2,000 per ounce and the resource price to $2,300 per ounce. This revision is expected to lead to a significant uplift in reported reserves in the 2025 annual report, as previously sub-economic mineralization is brought into the mine plans.
Financial performance. The financial health of Gold Fields has remained robust despite the capital-intensive nature of its growth projects. Group revenue increased to $4,500 million in 2023 and rose further to $5,202 million in 2024, driven by record realized gold prices of $2,418 per ounce. Normalized profit followed a similar trajectory, increasing by 36% to $1,227 million in 2024. Net debt increased to $2,086 million at the end of 2024 following the Osisko acquisition, resulting in a net debt-to-EBITDA ratio of 0.73 times. However, strong cash generation in 2025 allowed the company to rapidly delever, with net debt falling to $791 million by September 2025, and the leverage ratio dropping to a conservative 0.17 times. Valuation and peer benchmarking. The valuation of Gold Fields as of early 2026 reflects a company that is being re-rated by the market as it transitions from a high-cost producer to a low-cost, high-growth senior miner. At a market capitalization of $39.8 billion and an enterprise value of $41.3 billion, Gold Fields is currently trading at a trailing price-to-earnings ratio of approximately 20.7 times. However, the forward price-to-earnings ratio of 10.2 to 10.5 times suggests earnings expansion as Salares Norte reaches full capacity and the Gruyere consolidation begins to impact the bottom line.
Newmont currently trades at a forward price-to-earnings ratio of 14 times and a PEG ratio of 0.5. Barrick Gold has historically operated at a median EV/EBITDA multiple of 5.9 times, but has recently seen this increase toward 9.6 times. Gold Fields' current EV/EBITDA multiple of approximately 7.3 times sits below these larger cap peers, suggesting that it remains undervalued despite its growth profile. The company's PEG ratio of 0.19 to 0.26 is significantly lower than Newmont's, signaling that the market may not be fully pricing in the company's expected earnings growth. The free cash flow profile of Gold Fields is another key differentiator. In the first half of 2025, the group generated $952 million in adjusted free cash flow, representing a recovery from the outflow of $58 million in the same period of 2024. The company's free cash flow yield has reached levels as high as 31% at assets like Agnew and 18% at Tarkwa, supporting a dividend yield of approximately 1.4 to 3.6%.
Risk assessment. Investing in Gold Fields Ltd. involves a complex set of operational, jurisdictional, and financial risks that could impact its valuation and long-term production targets. Operational and technical execution risks. Salares Norte ramp-up. The project is highly vulnerable to extreme Andean weather conditions. In 2024, severe sub-zero temperatures caused pipes to freeze and delayed commissioning, contributing to a year-on-year production reduction of nearly 200,000 ounces. Although comprehensive winterization and heat tracing have been installed, the high-altitude environment, 4,500 meters, continues to present technical hurdles, including lower oxygen levels that affect combustion efficiency and equipment maintenance. South Deep technical hurdles. As a unique, high-tonnage mechanized underground operation, South Deep faces ongoing challenges related to challenging ground conditions and backfill rehandling.
In 2024, these issues hampered stope access and grade mix, although a turnaround plan has since stabilized production.
Jurisdictional and political risks. Ghanaian lease renewals. In April 2025, the government of Ghana initially rejected the lease renewal for the Damang mine, breaking a decades-long precedent of automatic renewals. While a 12-month transitional extension was eventually granted, it is non-renewable and set to expire in April 2026, signaling a potential shift towards state control or local ownership of the asset. The government has expressed intent to transition the mine to Ghanaian ownership following this period. Resource nationalism. The company operates in several regions where regulatory uncertainty and government imposts are rising. Geopolitical volatility and changing dynamics in international mining partnerships remain a constant concern for senior producers. Financial and market risks. Capital intensity of growth projects. The acquisition and development of the Windfall project in Canada represents significant capital commitments. The revised capital expenditure estimate for Windfall has risen to between $1.7 and $1.9 billion, up from an initial projection of $790 million in 2022. Sustained high levels of capital expenditure may limit the liquidity available for other strategic initiatives or shareholder returns.
Debt and leverage. Following the 2024 acquisition of Osisko Mining to consolidate full ownership of Windfall, net debt increased significantly. While the company has demonstrated strong deleveraging capabilities in high gold price environments, its balance sheet remains sensitive to project cost overruns and metal price downturns. Resource and reserve replacement. Gold Fields faces the constant risk of failing to replace its mineral resources and mineral reserves as existing mines are depleted. Although it has a strong track record of brownfields exploration success, particularly in Australia, the company requires a continuous blend of exploration and non-organic growth to maintain its long-term production plateau of 2.5 to 3 million ounces per year beyond the next decade. Conclusion. The investment outlook for Gold Fields is fundamentally tied to the successful ramp-up of its major projects and its ability to maintain cost discipline in a persistent inflationary environment. The company has moved from a three-layered organizational structure to a simplified two-layered model to improve operational efficiency and reduce corporate overhead, a move that is expected to save significant administrative costs over time. The transition toward a production target of 2.5 to 3 million ounces per annum is supported by an industry-leading exploration pipeline and a conservative approach to reserve modeling. As the group continues to demonstrate operational stability and delivers on its 2025 guidance, the gap between its current market valuation and its fundamental net asset value might narrow. For investors, Gold Fields offers a combination of operational turnarounds and near-term growth catalysts that can bring significant returns even in a volatile metal price environment.